Hello, everyone. Welcome, welcome. I know folks are trickling in very slowly and surely, but I'm very excited to host today's session. We'll give everybody maybe one more minute to sign on, and we'll get started. All right, welcome everyone to Financial Beginnings virtual speaker series to celebrate Financial Literacy Month. Throughout this month, we have a few more sessions to bring you experts on vitally important financial education topics. Today's session is breaking down the blockchain, cryptocurrencies, and tokens explained, and it's going to be fantastic. Cryptocurrency is one of the hottest topics requested by our students and our educators. So I'm so excited to have our expert guest speaker, Daniel Demian, to enlighten us all about it. Before I introduce him officially, I want to take a moment to share about who we are and to thank our sponsors that have made this entire series possible. My name is Joanne Dinganan. I am the market manager at Financial Beginnings California. I'm just as passionate about financial education as each of you here, and I'm so excited to host you all here today. Financial Beginnings Oregon, Washington, California, and Nebraska exist to provide free, unbiased financial education across our states and beyond. Our programs are designed for all age groups, and each lesson is facilitated by a trained volunteer. Please visit our website, www.financialbeginnings.org, to learn how you can bring our programs to your community or volunteer with us. We're always looking for folks who are just as dedicated as we are. Now, again, today's session is breaking down the chain, blockchain, cryptocurrencies, and tokens explained. Our expert speaker today is Daniel Demian. He is the senior financial advice expert at fintech company Albert. If you do have any questions for him throughout the session, we will be doing a Q&A at the end. So type those questions and please post them using the Q&A feature, if you will. I will be monitoring the chat box, of course, too. Just reminding you all, I'll also be sharing links throughout. One more housekeeping note. We will be sending out all the webinar recordings and slide decks once the series is over in early May. So look out for that. But in the meantime, all webinar recordings can be found on Financial Beginnings Oregon's Facebook page. So if you want to, do some referencing, or for even folks who weren't unable to attend today, they'll be able to see it on the Facebook page. Now I'd like to take a moment to thank our incredible sponsors for making this series possible. First, a huge thank you to Bank of America, our presenting sponsor of this year's series. Thank you for your belief in financial education. We've invited the one and only Jessica Fisher, Vice President of Life Event Services, and she's here to share a few words. So Jessica, welcome and take it away.
Joanne, thank you so much. Good morning, good afternoon, good evening from wherever you might be joining us out there in cyberspace today. As Joanne said, my name is Jessica Fisher. I've been with Bank of America for 14 years now and have the pleasure of serving on an amazing team called Life Event Services here at the bank. That's my day job, but my yay job, as I like to refer to it, is I am the chair of Bank of America Community Volunteers for Oregon Oregon and Washington. And so I have the distinct pleasure and honor of being able to connect our employees to nonprofits in our market to spend some time giving back and serving the communities that we live and work in. So it's an absolute pleasure to welcome you all today to the Financial Beginnings Virtual Financial Literacy Conference and to be a part of introducing this fantastic session to you all. Bank of America is truly honored to be the presenting sponsor of this conference. And we are a long time supporter of Financial Beginnings because advancing financial literacy and truly empowering everyone to have pathways to economic mobility is really a key part of our mission at our bank. Here in Oregon specifically, we actually helped to launch the organization with an early investment and continue to support them today through sponsorships like this, volunteerism, and Financial Beginnings Oregon was actually a recent awardee of our Neighborhood Builders Award, where they were granted $200,000 to launch their Financial Empowerment Fellowship Program. We are thrilled to have such a strong partner in ensuring that all youth have access to something as so critical and so key as financial literacy. Thanks so much, Joanne, and to Financial Beginnings for having me here today. We are so proud and so excited to continue our support of everything that you do to help youth across our communities. So without further ado, I will hand it back over to you, and everyone truly buckle up and enjoy today's session. It's going to be a good one.
Thank you so much, Jessica, for taking some time with us today. We so appreciate your work and your support of Financial Beginnings and today's conference. So thank you so much. Another huge thank you to our other sponsors, On Point Community Credit Union, who is our impact sponsor, and to all of the sponsors who have supported this series. We can't thank you enough. This wouldn't be possible without any of you. All of our sponsors are Bank of America, On Point Community Credit Union, BECU, the Division of Financial Regulation, Department of Consumer and Business Services, PNC Bank, FP Transitions, Northwest Credit Union Foundation, State Farm, US Bank, Citizens Bank, and FNBO, or First National Bank of Omaha. So thank you to all our sponsors. Again, we couldn't do this without you all. Again, I hope to see you at these upcoming sessions. We have a lot of good stuff coming up still for the rest of the month. So if you haven't registered, I'm going to type the link into the chat box so you can check out the rest of the programming. Would love to see you there. But without further ado, I'd love to introduce today's session, Breaking Down the Chain, Blockchain, Cryptocurrencies, and Tokens Explained. It'll be led by our expert speaker, Daniel Demian. He is the Senior Financial Advice Expert at Albert. He brings with him a wealth of knowledge, a diverse range of experience in financial services. Having worked in institutional finance and private equity as an analyst, he found that his passion falls with explaining and utilizing complex financial strategies in simple ways to everyday people like me. Daniel is continuously looking for ways to stay in touch with the ever-evolving financial industry. Lately, he's been researching blockchain technology, cryptocurrencies, and the metaverse in an effort to filter through the jargon, the scams, and understand the new technological landscape. He earned his bachelor's degree in business commerce from York University and is a chartered financial analyst level 3 candidate. When he's not working on improving his and others' financial literacy, you can find him working out or enjoying the outdoors. We're so grateful to you, Daniel, for sharing your wisdom with us on this important discussion. So without further ado, take it away, Daniel.
Awesome. Thank you. Thank you so much, Joanne, for the warm intro and the invitation to speak at Financial Beginnings FinLit Conference. I'm super excited to be here with all of you today and talk about a topic that for some can be overwhelming to tackle alone. My goal for today's session is that we can all walk away with a better understanding of blockchain technology and cryptocurrencies. I hope following this session, you, as one of my favorite authors, Daniel Kahneman says, are able to expand your water cooler conversations at the office, school, or in public. Or in today's age, as I think, make those first 5 minutes of the Zoom call a little less weather and more, did you know? For today's session, we have approximately an hour together where we will cover the following topics. First, blockchain 101. Here, we'll gain an understanding of what a blockchain is and how it works. Next, the major two cryptocurrencies, Bitcoin and Ethereum. You've probably heard of them or might even be an expert on them. Regardless, we'll cover what they are, why they exist, and how they are used. With an understanding of cryptocurrencies behind us, we'll cover two consensus mechanisms, proof of work and proof of stake. These mechanisms are essential to operating a cryptocurrency blockchain. After the mechanisms, we'll explore some of the latest additions to the cryptocurrency world through ERC20 tokens and NFTs. Spoiler alert, I'll also tease the metaverse a little bit here. Finally, we'll end with a quick glimpse into what the future of cryptocurrencies hold, followed by a brief Q&A. Please feel free, as Joanne said, to drop any questions you have in the chat box, and we'll get to them at the very end of the presentation. So let's enter the blockchain. First, it might come as a surprise, but the concept of a blockchain has been around since 1991. It was first introduced by two researchers in a paper as a solution to storing data in a tamper-free way. See, the issue with traditional way of storing data is that you can always modify it, delete it, and it's typically central to a computer or a hard drive. Think of how you store documents on your computer. You can open a Word doc, write an essay, and then save it on your computer. But then you can modify that essay, delete it, or move it to another computer. The issue is that it becomes very hard to track these actions. And in the case of a criminal investigation, the suspect can simply delete all that data that incriminates them. The blockchain was introduced to solve these issues. It presented a new way to store data virtually, so it's not centralized to one computer, rather decentralized and spread over thousands of computers, or what is referred to as nodes around the world. Each node holding a full set of the data or ledger. So if one node or computer was to go down, the other has the data present. Similarly, if anyone tries to tamper with or modify their own set of the data, the other computers can step in and be like, hey, this isn't the same data that we have. You're up to no good. So by using a blockchain, you and I can trust that the data is coming from and its history, since all the new data and its history is easily verifiable and present. Not so complicated, right? So based on what we know on the blockchain so far, here are the key features summarized, and through terms you might hear in blockchain industry discussions. First, for it to be a true blockchain, you cannot delete or change existing data. This makes it immutable, which means cannot be changed. Second, you can only add new information to a blockchain. This is referred to as being append only. Third, blockchains are decentralized. So unlike the data on your computer, which is central to your computer, the blockchain data is spread out over thousands of computers that service that blockchain. Each computer, or what we call a node, has a full copy of the data. So if one goes down, the blockchain is still intact. Get a better understanding of this, think of a server farm. Companies like Google, Amazon, and Microsoft have huge buildings spreading out over acres of land that hold thousands of machines that store their data. This is referred to as a server farm. Now, what happens if this server farm is attacked or destroyed? Or if it loses access to power? Or someone tampers with the servers? The result is a potentially catastrophic loss of data, which can result in a huge disruption in our lives. We've already experienced this. We've experienced this on the days Facebook goes down, Instagram goes down, and WhatsApp goes down. And it's not too fun. So now that we understand how the blockchain works, we should have a straight path to understanding different cryptocurrencies out there and make you all crypto experts. Let's start with the world's largest cryptocurrency, Bitcoin, which as of April 20th is worth more than $790 billion. See, Bitcoin was created by an anonymous programmer under the pseudonym Satoshi Nakamoto. If you're thinking, wait, what? That's right, we don't know who created Bitcoin. So at the end of the presentation, please comment with your theory. If it's a conspiracy theory, even better. I love a conspiracy theory. Getting back to topic, he or she proposed a blockchain where, one, people can send each other money faster than the normal banking system. Two, without the typical restrictions or requirements associated with the normal banking system, such as identifying yourself, the reason for transfer, etc. So in a short way, in an anonymous manner. And three, in a decentralized fashion. So there's no data sharing issues or the need for a middleman. Additionally, this allows everybody to see all the transactions in the blockchain, but not who's doing the transactions. In addition to all its features, the Bitcoin blockchain has some rules. First, the maximum amount of Bitcoins that can ever exist is 21 million coins. So far, we have around 19 million coins mined. Second, miners or the computers that work to settle your transactions must solve complicated cryptographic math, referred to as a hashing function, to find the next block in the blockchain that settles your transaction. Third, the first to find the next block in the blockchain earns the block reward. Currently, that reward is 6.25 Bitcoin. Fourth, a block can only be created every 10 minutes or so. So the difficulty of finding a block is adjusted as more miners join the network. Fifth, the reward for finding a block is halved every 210,000 blocks created, or approximately every 4 years. So at this rate, we would have mined all 21 million Bitcoin by the year 2140. And six, every new block has to be verified by the other miners in the network to ensure it's not malicious and it's correct. Remember, every node or computer mining has a full copy of the data in the network, and each block added has to be added to the previous block. So everybody can see the previous transaction history and balances of each wallet and verify that the proposed transaction to settle that block is correct. To conceptualize this, imagine I wanted to send my friend Bobby 10 Bitcoin, but I don't have the balance. Now, if I was a malicious miner, I could potentially try to make this transaction settle and hope no one would notice that I'm sending Bobby 10 Bitcoin when I don't really have it. However, since everybody else has a copy of the ledger, they can see my account balance and ensure that the proposed block, which I said settles the transaction for sending Bobby 10 Bitcoin, is coming out of my wallet, which has that 10 Bitcoin. Any errors caught will invalidate the block that I'm proposing as a miner, and the other miners will step in to try and actually settle the correct transactions. So why Bitcoin? Why not just use fiat money like the US dollar, euro, pound, and the traditional system? Well, the support for cryptocurrencies is centered around a few limitations currently present with the current financial system. First, imagine you wanted to send a wire internationally. With the current system, the process typically takes a couple days, and there are limited hours that you can send a wire during. This makes the transfer of money slow. Additionally, you have to have various pieces of information, like the bank name, the person's name, their address, the bank's address, the SWIFT code, account number, routing number, etc. With Bitcoin, all you would have to have is the recipient's wallet address. Second, settlement times for cash to hit your bank account from another bank is typically a couple of days. With Bitcoin, a payment is confirmed on average in 10 minutes, and that amount is available to use immediately in your wallet. Third, due to a centralized structure of institutions, there is currently a lack of data being shared, which causes bottlenecks in speeds, but also gives opportunity to fraud. So let me give you an example of a common scheme for check fraudsters when depositing a check. So a check fraudster wants to deposit a check at Bank A from Bank B, knowing that there's no balance there, with the intention of withdrawing the money right away. They prey on the bank's good faith to give them access to the check's funds right away. This is also why banks typically put a hold on your check, so they can confirm the balance and retrieve the money in case there was a scheme happening. This is good as it protects the bank, but doesn't provide the smoothest user experience for those of us not trying to fraud the system. Additionally, you can say, hey, I prefer Cash App or Venmo. Well, that's fine too. And yes, you can potentially get your money faster than a check that way, but you still have the centralization issue, which is your money is central to Venmo or Cash App. So if either of them go down, you also risk your money. So with a solid understanding of Bitcoin, let's turn to an example of how a transaction is entered and now settled in the Bitcoin blockchain. After this, you should be a complete pro and be able to hold down the best water cooler conversations about Bitcoin ever. Let's check it out. First, a transaction is made or requested. In this case, Dan wants to send Bobby $5. These transactions are sent somewhere. That's a wait list, which Bitcoin's called the meme pool. Second, computers, or what we call miners, pull transactions from this meme pool and try to settle them by finding the next block. This is done by solving that complicated cryptographic math called the hashing function. Third, the first miner to find the next block can earn a block reward. In the case of Bitcoin, it's currently 6.25 Bitcoins. Fourth, before the miner can claim their glorious reward of 6.25 Bitcoin, or at today's rate, roughly $250,000, their calculations have to be checked by all the other miners. This part is a lot easier, but is essential to Bitcoin's consensus mechanism, which we'll cover shortly. Fifth, and finally, if the math checks out and all miners are in agreement, the transactions are settled and a new block has been added to the blockchain. The process is then repeated as long as there's a wait list, with a new block being created every 10 minutes. If you're like me and you love the math, if you had a supercomputer that beat out every other miner every time, and you mined all possible 6 blocks in an hour, that hour would have made you roughly $1.5 million. So now that we're Bitcoin experts, let's cover one concept that will help us master our understanding and easily understand the other cryptocurrencies out there. And that's learning what a consensus mechanism is and proof of work. So recall that one of the rules of the Bitcoin blockchain was that miners needed to solve complicated math to find the next block, which also needs to be checked by other miners. This process of solving the complicated math or hashing function to find the next block and have your mathematics checked by your peers is called proof of work. In other ways, you can say it's your way of proving the math you did and the block you're suggesting works. Some benefits of this consensus mechanism is that it ensures the work is accurate and the block hasn't been tampered with or modified, since other miners can check your work. However, there's a major disadvantage to it, and that is the process of solving for the next block and checking other people's work consumes a lot of energy. This is why Bitcoin gets a bad rep for not being environmentally friendly. So to solve the energy problem and make Mother Earth happy, proof of stake was introduced. Here, miners take turns producing blocks to earn rewards instead of solving the complicated cryptographic math. The expectation is that miners follow the rules of the blockchain, and the new block created hasn't been tampered with. With proof of work, we could ensure that the new block wasn't tampered with by simply checking your math. But with that out of the picture, we need a way to trust the miners. So to help us trust the miners and guarantee that the miners won't create fake transactions, miners need to escrow or stake the reward currency on the blockchain, similar to getting a secured credit card where you secure your credit with a deposit. If a miner has been found to have broken the rules, the escrow or staked funds get seized, and the miner that found the violation gets those seized funds. Now, Ethereum is a blockchain that is currently in the process of moving over from proof of work to proof of stake. Let's learn more about Ethereum. Ethereum is the second largest cryptocurrency and blockchain in the world. As of April 19th, it's worth more than $372 billion. The blockchain was first introduced in 2013 by programmer Vitalik Buterin and launched in 2015 by Buterin and Joe Lubin. Its native coin is called Ether or ETH or ETH. So as a quick recap, Bitcoin is its own blockchain and has its own cryptocurrency called BTC. Ethereum is its own blockchain and also has its own cryptocurrency called ETH. So what's the difference? Well, the idea behind Ethereum was on top of allowing people to send money to each other, the programmers wanted to be able to program transactions and allow for applications to be built on their platform. They thought, Bitcoin is cool, but Bitcoin is cool. It lets us send money fast, but it doesn't have much features. For one, I'd like to program my transaction. So if I want to send Bobby money, I want to send Bobby money only if Bobby does a job for me. I also want to build applications similar to the ones that exist in the real financial world, like getting a loan, earning interest. Bitcoin's program didn't allow for these things. Additionally, Bitcoin was limited in the amount of coins that will ever exist, which made it more like a digital gold, where gold has a finite amount rather than being a currency, where we can print, and in the case of cryptocurrencies, mine more of. So the developers of Ethereum set out to solve this problem by creating Ethereum. So what they did, they created a platform where you can have smart contracts. A smart contract is like an enhanced traditional contract, except with 100% accountability. Currently, if you're remodeling your kitchen and you hire a contractor who says they'll finish the work in 1 month and for $20,000, a contract between you two can make this legally binding. But what happens if the contractor breaks their end of the deal? Or what if you break your end of the deal? Ultimately, the resolve is to sue the other person, or if we're in the 1920s, probably hire the mafia. Either scenario isn't that good. Kidding, but you can see what I'm getting at. A smart contract eliminates this by making contracts automatic and enforceable. With the kitchen remodel example, we programmed the contract to only release the money to Bobby when the kitchen is completed in 4 weeks. Additionally, we'll tell Bobby, you'll also have to stake some money. So if you break your word, I get your money instead. Pretty cool, huh? So why Ethereum? First, the blockchain aimed to solve a speed issue currently with Bitcoin by processing a larger amount of transactions and at a faster pace than Bitcoin. This was a problem developers anticipated as the Bitcoin blockchain grew. Remember, Bitcoin takes on average 10 minutes to settle, and it was really created to facilitate payments and act as a store of value than just be a payment processing system. Second, Bitcoin has a finite nature, which makes it more like digital gold or collectible than a currency. To truly be like a currency, Ethereum does not have a finite nature, but rather new coins can continue to be produced beyond a certain limit. Although Ethereum is faster and produces new coins beyond a certain limit, it is more expensive to operate. With Ethereum, the concept of a gas fee was introduced. The gas fee is composed of a tip for the miner processing the transaction and a base amount that's burnt. That's right. It's like the scene in The Dark Knight where the Joker is burning his half of the money. That's what's happening with the base fee in Ethereum. That said, the gas fee can increase as more transactions need to be processed, making it more expensive to operate on the Ethereum blockchain and vice versa with low volume. Third, the blockchain introduced two new features that helped cryptocurrency area gain a lot more traction. The first was, as I previously mentioned, smart contracts, which allows you to program transactions and build programs referred to as decentralized applications on the blockchain. And the second is the ability to launch your own token on their platform without having to open your own blockchain. This token can be used to operate your decentralized application or be the currency of choice for your application. Or it can be a complete joke or a meme, like a Doge or Shiba coin that was created. The ability to launch your own token and raise money from releasing this token or cryptocurrency is what introduced the ICO boom, which we saw in 2017, and why there are thousands of cryptocurrencies that currently exist. These thousands of coins or tokens that can now exist on the Ethereum blockchain are referred to as ERC20 tokens. So what are ERC20 tokens? ERC stands for Ethereum Request for Comment. And if you guessed it, ERC20 is the 20th request for comments. Essentially, the Ethereum developers would propose a new way of launching tokens on their platform and ask for the programming community's input on it. This happened 20 times until everybody agreed on the rules and the format that will be used, launching the ERC20 standard on the Ethereum blockchain. So as we know now, Ethereum has the capability to run smart contracts or apps on its blockchain. These apps typically have their own token, so the developer can encourage miners to process their transactions, and they, as original owners of that token, are motivated to launch the great app that you will enjoy. Since the introduction of ERC20 tokens, there have been a number of successful coin launches, and we'll cover a couple now. First, stable coins. A stable coin is a digital coin that is introduced and backed by fiat money in a reserve account. For example, USDC is one type of a stable coin that currently exists. One USDC coin represents $1. For every $1 invested, one USDC coin is created. The dollars are kept in a reserve account that might be invested in some short-term and money market investments. The USDC is then issued to you to do as you wish. You can rest assured knowing it won't be volatile like a regular cryptocurrency, such as Bitcoin or Ethereum, as the makers of the coin work to maintain this peg between the US dollar and the USDC. The idea is that crypto traders can hold on to the currency instead of moving back to dollars when needed, and it can be used for transactions just like the US dollar is used. It's currently available on many blockchains, including the Ethereum blockchain as an ERC20 token. So a second type is reward-driven tokens. Remember how I said you can launch apps on the Ethereum blockchain? Well, one app that launched is a crypto browser called the Brave browser. The Brave browser provides users with a way to interact with the internet, like your Google Chrome or Safari, but with privacy at its core. It does that by providing you with an ad-free experience. Imagine having a built-in ad blocker. Additionally, by using the Brave browser, you can opt in to be shown ads in the Brave community in exchange for BAT tokens. The more ads you see, the more tokens you can earn. You can then use those tokens to tip creators that you liked ads from, or tip people in the Brave community, or simply withdraw it, transfer it to US dollars, pocket it, or maybe transfer it to a different coin. It's pretty cool. So I just went over a few applications on the Ethereum blockchain that were stable coins and reward-driven coins or a crypto browser. Let me share with you, since you made it this far in my presentation, my $1 million idea to replace Uber by building an app on the Ethereum blockchain. So I'm going to call this app Dan Drives. And the way it would work with people will input the places they want to go, the times they're willing to go, and the minimum and maximum amount they would pay. The drivers then would do the same, inputting the places they are willing to go, the times they're willing to go, and the minimum and maximum amounts they would require. Then using a smart contract with conditional statements, we would match these people at the lowest common price that is available between them. Doing so, I believe I can replicate the Uber ride experience without the fees or the middleman. But what would incentivize me to create this app? Or how do we keep everything running with no fees? Well, if I want to make money, I would issue my own token. So as an owner of this token, let's call it a DanDrive token, I can make money as its price increases. Then I would set this token to be the payment currency in my app. So riders and drivers alike will have to buy my token if they want to use the app and use that token to transact. Miners would then come in and match the transactions, which are the drivers and the passengers, adding them to the blockchain. As a reward, they get the gas fees, which I would pay out in DanDrive tokens. The more people who use DanDrives, the higher demand for DanDrive coins, the more the miners, the drivers, the riders, and the investors' coins are worth. This keeps my app running and all parties happy. Of course, it's not all daisies and there's a major risk with my idea, and that's it could fail and my coin could become worthless. Or there could be low demand and the coin price exhibits extreme volatility, which makes the holder uncomfortable. Here's where a little history can be important to know. If you think of cryptocurrency applications as software, think back to the dot-com bubble of 2000. It's estimated that 7,000 to 10,000 new online companies were launched in the late 1990s. And by the mid 2003s, around 4,800 of those companies have been sold or gone under. That is 48 or 68% of those companies. I think you get the gist of how an app can run on the Ethereum blockchain now and what future applications can look like beyond the financial system. I'll take a quick 10-second pause here. And I'll check on the chat box just to see if there's anything that I can cover. And we can continue and cover questions at the end. So now let's talk metaverse. There has been a lot of buzz around this area recently, and it's because it's almost dreamlike. The metaverse refers to virtual worlds that are currently in development aimed at incorporating virtual reality hardware in some cases to provide a fully immersive experience. On a general level, think of your favorite video game, for example, Call of Duty or Fortnite, and how there are maps you can go and play with other people online. Now imagine instead of just looking at the screen, you were wearing a virtual reality headset and it felt like you were in the map. Now imagine instead of just playing a shooting game, you can walk around normally, maybe go to a town where people aren't shooting. Maybe go to school and attend a lecture, your favorite virtual cafe to chat with some friends. Anything you would do in the real world without physical interaction, like eating, is theoretically possible in these virtual worlds. So there are currently a bunch of projects in development, but for the sake of time, I'll only cover a few. First, the Sandbox. The Sandbox metaverse is a virtual gaming ecosystem that allows its users to create and animate your own 3D objects, like an avatar that represents yourself, and game and interact with virtual worlds. You can also sell items to others, making this a valuable creator's world. Transactions in this world are conducted with the SAND token. Second, Somnium Space Metaverse is a virtual reality ecosystem that allows users to create, experience, and trade digital worlds and NFTs. For example, you can create a house with a pool and go swimming in that pool virtually, or get yourself a cool spacesuit, dress your avatar in it, and hit the virtual clubs. You can also sell any of your creations using the built-in NFT marketplace or sell experiences like opening a club and hosting a performer virtually, like Snoop Dogg in the virtual world. Transactions in this world are conducted with the Cube token. Third, Decentraland Metaverse is a virtual world where you can play, explore, and interact with games, activities, and experiences. You can also purchase land and build on it. You can experience the world through a virtual avatar, and other things like games and digital environments can be created in this virtual world. Transactions in this world are conducted with either mana, land, or estate tokens. All these worlds currently exist on the Ethereum blockchain, and their tokens are approved ERC20 tokens. So far we've covered Bitcoin, Ethereum, and its native coin Ether, and ERC20 tokens, and all the different type of ERC20 tokens and the applications that could be accompanying them. Now there's another standard under the Ethereum blockchain that gave the path to a new type of token. This standard, ERC 721, gave way to NFTs or non-fungible tokens. Non-fungible means it cannot be exchanged for another or be split. For example, $1 is fungible. If we both have $1, I can give you mine and you can give me yours, and you wouldn't have lost anything. They are both worth $1 each. That is what fungibility entails. Now, an NFT is non-fungible, so it cannot be exchanged or split, inherently making it a one of one. The concept has recently gained a lot of attention, especially in the art community, as it gave artists a way to monetize their artwork, all of which are unique one-of-ones. It also allowed buyers to be able to gain from the application of unique artworks and trade it actively. However, it doesn't stop there. NFTs are getting a lot of attention for its future applications. For example, imagine combining them with real assets as a proof of ownership, such as buying a trading card and then getting an NFT to prove the authenticity of this trading card that you own, and also show the history of this trading card with the previous owners who owned it before you. Imagine having a Michael Jordan one-of-one basketball card that you bought from Michael Jordan himself and was issued by the Jordan brand. Then when you sell that to somebody else, it could inherently have value because of where it came from, who had it, and its history, and the clear displayed ledger that is available. Since NFTs live on the blockchain, you can view all transaction history and can verify the authenticity of the NFT issued itself. The applications are endless when you start to think of all the different mediums an NFT can be applied to. Some other floated ideas currently out there are to have NFTs created to represent fractional ownership in pieces of real estate, or maybe even a company. So we've covered a lot so far, and we're close to wrapping up. But first, let's consider two more topics that are important to the crypto community. First are the dangers that this space faces. One is that cryptocurrencies, due to their anonymous nature, may be used to facilitate black market transactions. This is why recent regulation required exchanges to KYC their users. Second, cryptocurrencies kept online or in hot storage, as it's called in the community, can be suspect to network hacks and potentially stolen. As new blockchains emerge with the promise for more functionality, their coding becomes larger and more advanced, which opens it up for bugs or errors, and hackers like to exploit those errors. Third, as the blockchain gains more volume, older ones can face network speed and congestion issues. Fourth, cryptocurrencies are known for volatility, and that problem still remains. Holding a token can be 4 to 5 times more volatile than holding a stock, or even more in some cases. And finally, some decentralized blockchains can be slow to release significant upgrades as everything goes up to a vote. We saw how many requests for comments it took to launch ERC20 and how many it took to launch NFTs ERC721. Last, let's discuss some regulation. Back in March, President Biden issued an executive order that called for a review of digital assets, including cryptocurrencies. The main objective of this order were consumer and investor protection, financial stability, mitigating illicit finance and national security risks, having US leadership in the global financial system and economic competitive landscape, and financial inclusion and responsible innovation. Orders like these are welcomed by the crypto community and are a step in the right direction for more responsible development. Currently, the space has some limitations, such as lack of ETF approval, citing concerns about market manipulations, custodial risk, audit risk, and a whole bunch of other factors. Finally, taxes. For a while, especially back in 2017, there were a lot of questions about taxes when it came to holding cryptocurrencies. Some investors argued it should be treated like a collectible, some like a commodity, and other like a stock. Each of these is taxed differently. Ultimately, the most recent classification from the IRS is that cryptocurrencies are to be classified as property, subject to short and long-term capital gains, and there is an FAQ list to help us better understand this classification. So we've reached the end of our workshop. It's been a complete pleasure being able to talk to you, and I hope everybody is a little bit more confident and knowledgeable in this space. I added some of my favorite resources that you can use to learn more about cryptocurrencies in this space through Coinbase, Robinhood, SoFi Crypto Fundamentals, Gemini Webinars, and Crypto.com. And I truly appreciate the time you've given me. I'll now be going through the chat box to answer any questions. So please drop your questions or comments that you have, and I'll get to them.
Thank you, Dan. We do have a couple questions. I will put those links in the box. Thank you, RJ. We have a question from Jasper. Thank you. Does crypto exist without fiat to provide it with tangible value?
So the question about how to value cryptocurrencies is currently being debated. There are different ways that people want to value cryptocurrencies. Some, view it as a currency where you have to have it backed up by a fiat currency. Others see it like a software company where you have to see what is the blockchain working on, what are they trying to build, what are they trying to do. But nothing really has been agreed upon, or there's no one set standard. So as of now, when you look at a market cap or a valuation for a cryptocurrency, it's most likely the result of supply and demand forces, which is how many people are buying it, pushing up the price, and what the supply is relative to that. If there's low supply and high demand, the price will go up. If there's high supply and low demand, the price will go down.
Awesome. Jasper, I hope that answered your question. There's another question from Melissa. How does someone become a miner? And how many are there?
That's a great question about mining. There's currently estimated around 1 million miners, and probably even more. How one becomes a miner, I'm not an expert in that area, although from what I've heard and what I've seen is that it requires, and as we've learned about it through the proof of work mechanism, is that it requires intense computive resources. From what I've seen now at this level of competition, it's actually partially why, if you're into gaming and you're building your own computer, why it's been so expensive to try and find graphic cards for your computer, is because all the miners are competing for these video cards and are building massive computers and warehouses to be able to mine cryptocurrencies. and it's pushing up the costs associated with it. So it isn't as cheap as it used to be back in when Bitcoin was first launched in 2008, and you could do it at home with a regular computer. Also, one other note on it is that miners these days are typically located in areas that don't that have low electrical costs. So you'll see videos of huge warehouses in northern Russia where it's just ice storms and like you have snow up to your neck, but it's where electricity is cheap and it's where you can keep these computers that are solving such complicated math to earn that 1.5 million an hour cool, or they will overheat, and that could not be good.
Thank you, Dan. Another question from Jasper. What is the value of crypto for folks of lower socioeconomic status?
That's a great question. How would you view crypto for yourself? So I personally view crypto as a alternative asset class. So like any investment, when you are in a position to invest, you have to be financially well off to get to investing. So that goes along with anything, buying a house, investing in the stock market, portfolios, whatever it might be. You have to make sure that your own personal core financial well-being is taken care of, and that's you're free of debt. You have an emergency fund, and you don't have any immediate short-term goals or medium-term goals even that require you to keep this cash as safe as possible. From then, you can start exploring investment opportunities. And obviously, as you would be talking to your financial advisor who would find the most appropriate opportunity for you. But as an advisor, you typically want to minimize risk. I would place cryptocurrencies at the highest risk spectrum when it comes to an investment. And typically, the investors that are eligible for the highest risk spectrum have the highest financial capabilities to tolerate that risk. So they're the ones, as an advisor that I'd be talking to, that would have a very long time horizon, very high risk tolerance, and very high net worth or financial well-being. And at that point, they could be more appropriate for cryptocurrencies. So that is how I personally view it. I would recommend that you definitely chat with a financial advisor to sort of get what their opinion is based off of your unique financial situation, and see what the value is there.
Thank you. Great question. I have a question from Tony. Are most organizations starting to accept cryptocurrency as payment for products and services?
Yeah, so I wouldn't say most organizations are, but I would say that there is a shift that is currently happening where before it used to be almost a forbidden topic and regulation was little on it and there wasn't much knowledge on the space. So corporations weren't touching it. But now that we see with regulation on how is cryptocurrency going to be taxed and executive orders like the one President Biden issued, they sort of pave the framework for corporations to take more bold steps in the direction, knowing that we're not sort of dabbling in a forbidden space. So corporations are taking steps to adapt cryptocurrencies, and if you look at the news on it, you'll see huge names investing in this area. But then it also ties back to like sort of like my tidbit about, are you financially ready to invest in cryptocurrencies? So I would say a corporation's risk tolerance is that they have a balance sheet with billions of dollars of money. So when we say, oh, Visa or whoever invested $100 million in Bitcoin, that's really pennies for them based off of how much money that they're investing in all the other ventures. So we want to see it as their risk tolerance and not really as like, oh, Visa is investing 100 million or whatever it might be. That means that this is the next big thing. So that's where we want to be just a little bit careful when we're examining Bitcoin and its corporate usability.
Thank you for that question and answer. I have a question from John. It's quite long. I'm going to try to summarize it here. Do you feel cryptocurrencies are actual investments, or is it closer to trading or a speculative behavior right now? with the short history, relatively 14 years since the original implementation paper versus the 100 or so years of stocks and bonds. It allowed us to determine a reasonable rate of return. So, in summary, how long do you think before crypto becomes a legitimate investment asset?
That's a great question. I would personally, and not to like be taken as like investment advice, if you think about it as you were to think of a software company in the 1990s, back then when the internet was first launched, I think there's a video that I saw of Bill Gates explaining email to somebody on a talk show host, and they were making fun of him. They're like, email, like, have you heard of a fax? Have you heard of mail? You know, so the concept sounds foreign when you don't really understand the technology or the applications behind it. And that also gives opportunity for multiple different companies to come up and be like, hey, here's how you should do email. Here's how you should do email. Here's how you should do email. And I'm pretty sure that we've all grown up with companies that have done email that we don't even use anymore. So if you view it as an early space in the software industry and is still gaining a lot of adoption, but hasn't really matured yet, then maybe you can see it, you know, assuming that we're using the 1990s to like a 2003 framework, then 13 years. But that's, you know, subjective to how you view the industry, how you view companies, where you're basing it off of or anything like that. The fact is that, you know, it is a very risky space, but it's exciting to see the way things are advancing, and it's just cool to be able to witness it and be alive in this time.
I love that, Dan. Thank you for sharing. I had that same exact question. So I hope that answered that for you, John. Last question for the session. Thank you all for participating. For those of you who did submit questions, last one for today is from Melissa. Do you have a pulse on how the crypto community feels about the executive order?
So with everything, I think a good initial pulse for how people react to news is always looking at the markets. As an advisor, when, you know, news comes out from a company and the stock either goes down or goes up, you know, that gives you an indication of how the community is responding to that news. When the order did come out, cryptocurrencies responded positively to it. So I personally take that as, hey, we're liking this order. And regulation is not bad. Regulation is actually pretty good because it paves the framework and it opens up the opportunity for institutions to come in and be like, I feel more comfortable putting my money in this space now. It's when regulation becomes abusive or people don't agree with certain things that create these forks. But other than that, I'm pretty pro having a regulated space, and I think it's been pretty well received by the community.
Thank you. Thank you, Melissa, for that question. And thank you, Dan. That was so informative. I understand it just a little bit more when it comes to cryptocurrency. So thank you for explaining it in such a way that even I can understand. I am so excited to find a metaverse that I dig with. A la Sims 4. I'm a big fan. So
Nice.
maybe we can find a Sims 4 type of world for me. Again, thank you, Dan, for spending the time to explain cryptocurrency and the blockchain for us. I thank you all for joining today and taking the hour to learn. I am a daily learner, a lifelong learner. Hopefully you all are too. And thank you again for joining us for our financial literacy conference. Join us for the rest of the month. We have some great sessions left. And with that, have a wonderful day. Again, thank you, Dan. Great job.
My pleasure. Thank you all for your time. Have a great day, guys.